Welcome to the weekly update, where we'll go over the action in the market for September 26th through the 30th, and then see how things look for the week of October 3rd through the 7th. And it was a wild week, not only because of what's happening in the US, but we have a lot of geopolitical things really in play right now. Economically, UK is kind of at the forefront right now because they're having some real issues in that country. And I'll go through and talk a little bit about that. I'll try to keep it really simple and really kind of top level as I go through that. We also have some other geopolitical events. There's more rumblings now in Russia that could escalate the whole Russia Ukraine scenario. We have the Nord Stream pipeline sabotage, which is what they're calling it. Not really sure who did that or why, but that could also serve to escalate things. We have other problems in the EU concerning energy and inflation, and things are going to get pretty difficult for folks in Europe during the winter. And they're already difficult for folks in the US. And hopefully, this is going to get to the bottom at some point and start to get better. But some of the people that I listen to and things that I read say it could get worse before it gets better, but we don't really know that. We'll just have to take it one day at a time or one week at a time and just analyze things as we go forward. So let's go back and talk about the week session. The S&P declined 9.3% in September. It was not a good month. This fit into the pattern of weak seasonality. A lot of times September is a weaker month, and that's what happened. For the week, we were down 2.91%. So that wasn't very good either. There's concerns about rising interest rates, of course, not only in the US, but globally. There's a lot of currency volatility going on. The dollar's holding up okay, not because it's great and wonderful, but because it's still the world currency at the present time. And there's other currencies that are really struggling, specifically the British pound. And that really had some problems this week, as are interest rates in the UK. And we also have the possibility and the reality of a global economic recession. And so all of these things were hanging over the markets this week, and that produced a lot of selling. What really happened that involved the UK? This has been coming on for quite a while. You might think, well, gee, now that the Queen passed away, the UK is falling apart. No, this has been building up for a while. It just kind of came to a head on Wednesday. The Bank of England started to buy UK government bonds. Okay. The idea behind that is that they're buying bonds, which pushes prices up and interest rates down. We know that as quantitative easing. That's what the Fed did during the COVID plunge. That's what the Fed did numerous times during the whole financial crisis back in 2008, 2009, and even beyond that. We could look at this as QE on the left-hand side of the road because it's in the UK. They tried to do this in order to restore order. Well, what was causing the problem? They have pension funds there, just like we have pension funds in the US, where they guarantee that they're going to pay people a certain amount every month. Well, a lot of this money in these pension funds goes into bonds, and that's how they use current returns to pay what they have to pay out now. Well, with interest rates so low, what they ended up doing is they would borrow short-term bonds and then use that to leverage their pension funds to get a better return. That's fine as long as interest rates were low. Well, when interest rates really started to go up, that produced a real cascading effect. And so some of these pension funds started to get margin calls, and they had to sell things in order to make it right, just like an individual would have to do that. Well, this creates quite a problem with things. So there was a lot of panic, and the Bank of England stepped in. And originally, they were going to start doing what the Fed is doing, just getting rid of some of the bonds that they already have. They're doing a quantitative tapering or lessening of their balance sheet, just like the Fed is doing. They couldn't do this as they were planning to do. Instead, they're doing the exact opposite. They're going back into quantitative easing, and they're calling this temporary purchases of UK government bonds. And they started that on the 28th of September, and they plan to continue that until October 14th. They're hoping that this will settle things down. Now, long term, this could have some ramifications. Here we are with the UK fighting inflation, doing stimulus type of actions. What's going to happen if this spills over into the EU? What's going to happen if this spills over into the US? Now, the US is a little bit insulated currently because it's the dollar that's causing a lot of these problems. As the dollar's been going up, the British pound has been going down. And I'll address that again here in just a minute. On Wednesday, we did see a good advance. Monday and Tuesday were down. Thursday and Friday ended up being bad. But we had a nice run up on Wednesday, only to give all of that back on Thursday. Here's where we talk about the British pound. It hit a record low against the dollar. So if you want to go to England, the exchange rate is a lot more favorable than it used to be, but they're also battling a lot of the same economic pitfalls and struggles that everybody seems to be battling right now. It did find support when the Bank of England held off with any support issues. They said, we're not going to come in. We're not going to go in and start buying the British pound, because that would start to push things up and bring the dollar back down. And at first they said, we're just going to wait and talk about this at our next scheduled meeting, and then we might do something at that point. Well, things were getting so far out of hand that they had to jump right in and start doing that. Then on Thursday, they have a new prime minister there. Minister Truss said that she will be sticking with her tax cut. That's another thing. That is a stimulus type of thing in an inflationary environment. And that sounds good on paper. And of course, people like lower taxes, but is that really healthy for the economy? And that's part of the battle that's going on. And they said originally, this is where things really started to go bad. When she made that announcement that we're going to have tax cuts here. And this produced a lot of selling with the gilts. That's what they call their bonds in the UK. And also that really started to hurt the British pound as well. And then it just fed over into this week. Then we also had Apple near the end of the week. They came out and said, well, you know, that old iPhone that we have, 14, that's what I was trying to spit out there. Well, it's not selling quite as good as we thought it would. Gee, do you think people want to go out and spend $1,000 on a new phone when they're just trying to put food on the table? So they dropped 8.1%, and that's the big company in the market. So when it goes down, it has a tendency to take the stock market with it. Also, Bank of America ended up downgrading the stock, and a lot of the losses ended up coming on Thursday and Friday. So that's why we saw that really nice bounce on Wednesday. It looked like things might be turning a little bit more positive, only to have Thursday and Friday not be very good days at all. Also, Nike came out and said, you know what? We've got 44% increase year over year of our inventory. We're making these shoes, we're making shirts, we're making all this stuff, but it's not going out and being sold. Well, that's not very good. And so for its fiscal first quarter, and it also warned that it expects to face continued gross margin pressure in the second quarter. That's not really good news. And Nike's one of the big guys. So this could also bleed over into other companies, and that made things pretty negative in the markets. Also, what happened, all the Fed officials that gave a talk this week, with the exception maybe of one who said, we might be going too far too fast. He said that in CNBC Europe. All the other folks said, nope, we're going to keep raising rates, even if it hurts. We're going to keep pushing those rates up to try to get inflation under control. We also had a record high 10% year over year increase in the CPI in Europe, in what they call the Eurozone. Those are the companies that make up the EU, and then kind of outside of that a little bit. They're making a 75 basis point. That's what everybody's considering that they're going to be doing. Well, it looks like that's pretty much going to happen now. So they're going to be raising interest rates there. But that is massively high, 10% inflation. They haven't seen that. Well, they say here, record high. All right. And then we also had in the US, the PCE price index. This is another inflation gauge that the Fed likes to use. And we can get a bit of an insight into what's happening. Well, the when you take out the food and energy and just look at the core, and that's what the federally fixates on, it was up 4.9% instead of the expected 4.7%. That's 0.2% more. The markets could have just tanked on that. They could have just gone down through the floor. It really wasn't as big of a decline as you might expect. We did have a lower open on Friday, but then some immediate buying. We did end up closing down on the day, but there wasn't this real sudden reaction, which may suggest something. On the daily charts, and as I'll show you here on the weekly charts, we're seeing a real convergence now. We're at some major support. We're seeing sentiment very fearful right now. We're seeing a lot of oversold conditions. These things are all coming together at the same time. We're also coming into what could be October, which can be a favorable season for the market. Yes, we've had some of our biggest crashes in October, but we've also had some really strong gains in October. We have a midterm election coming up. Folks are kind of jockeying around for that. Maybe there's some optimism over that, that there might be some changes and things might be going in a better direction. So this, when you take it all together, and then the one thing that I didn't mention, jobless claims continue to fall. And that's what the Fed is really using to justify, well, look at this. We're not in a recession. The employment situation is doing so good right now. You take all of that and you take the fear, you take the oversold condition, you take that we're at pretty significant support. Everybody thinks the market's just going to go in the toilet. And a lot of times that's when it often finds a bottom. Now, if we do get a bounce out of this, is it going to be significant? Is there going to be much to it? We are seeing pockets of strength, and I'll go through and try to pick out some of the positive things as I go through the charts. Things are still really negative and not looking all that much better into the future right now. But the stock market tries to look out into the future, and if they see something a little bit better, then than what they're seeing now, they'll use that to justify buying. But we still might be going down even more from where we're at right now before it does get better. Then we have Putin. He announced the unlawful annexation of 4 regions in Ukraine, kind of like what he did with Crimea back in, was it 2014, 2015? This isn't anything to make the world a better place, at least more stable. So it's said that Ukraine, they're not going to recognize this, and most other countries, probably including the US, and it will raise a lot of the tension in the conflict right now, because Putin also came out and said, well, yeah, we're going to do this and we're going to do whatever we have to do, including using nuclear weapons, if we feel threatened in this situation. So that's not a real happy message either. So there's a lot hanging over the markets, the world, everything right now. So it's really not a happy time, other than if you're a Seattle Mariners fan. They did make the playoffs, and I am a Seattle Mariners fan, and they broke a 21-year drought there. Okay, so let's go in and look at this. And for some reason, my slide is not advancing nicely. So for the week, we ended up being down 2.91%. Volume was above average. We have been really seeing that pick up. The technicals, yeah, they're negative. On the daily charts, they're very negative, but we're starting to generate possibly some new possible positive scenario signals. We're seeing fear really high. We're seeing the readings really low. And a lot of times that's when a market has a tendency to bottom. We're seeing some of those things in the weekly charts as well, but the real fixation continues to be inflation and interest rates, the whole geopolitical landscape that I talked about. We still have things going on in China. There's still some of the lockdowns. There's still some supply chain issues. Oil, it actually seems to be behaving a little bit. It's dropping down, which is a political ploy. We're coming up to an election, and gas prices are what we see every time we're driving and have to fill our tank. If they can bring that down, people don't feel as anxious about things. We might be getting some more Fed speak this week, earnings on an as company basis. And it's like the recession debate. Okay, well, things are just not looking very positive right now on a lot of different fronts. We do see it was a weakening trend, but it's starting to turn back up now, and it is negative. And I'll show you that chart. Here's how the week went. We had the really strong down day on Monday. We gapped higher, and then we're really down on Tuesday. So we had two pretty strong down days back to back. Here was Wednesday when it looked like, okay, maybe something's happening here. Well, then Thursday happened and everything really crashed down lower. We're seeing a little bit of this pattern of on the days when we have a down opening, late day, early weakness, late day strength. Then we saw a lot of strength on Wednesday. Even on Thursday, even though we really gapped down, we saw a little bit of buying coming into the close. Then Friday, we even in the face of bad news, we still tried to go higher. That didn't last very long, but then we ended up just going down and down and down and closing at the lows of the day. So it gets to the point where so much bad news is hitting the market almost gets immune to that. So are we at that point yet? You can't really quantify that very much. You just kind of have to get a feel for what's happening in that area. The Dow was down 2.9%, the Nasdaq down 2.7, the S&P down 2.9, and small caps, which this is one of the positive things. Mid caps and small caps were actually up over the 5 trading days in the past week. In fact, this shows this where the small caps, mid caps, they were not very positive, but they were positive, where we saw a lot of the rest of the market really have declines. Then going back to the all-time high set in the S&P 500, this is the updated version of how everything has been falling ever since. Looking at our sectors on the week, the utility sector, that had been holding up. Energy's been doing well, followed by utilities. Well, it just got hammered this past week. And 10 out of the 11 sectors ended up being down over the 5 trading days. The only sector that was up slightly was energy, and that was 2.19%. That was a little bit of a bounce in oil that we saw. Sectors here just shows energy was up 4.76% for the week, and materials ended up being positive, and then all of the other sectors ended up being negative on the week, with utilities really leading the way lower. And I have another chart to show you with Dow theory, just to show how utilities have really been dropping. Current market valuation still has us at fairly valued, and we're seeing these charts really calm down quite a bit because prices are declining. So you look at our aggregate score, and we're coming down a little bit more to this black line, which is the line between positive and negative. The yield curve model continues to be below this yellow line, so we are fairly valued there. We're not overpriced, we're overvalued. The Buffett indicator with the declines that we're seeing also is now fairly valued. The PE model that they use here also fell below the yellow line, so that's fairly valued. The interest rate model is actually falling a little bit negative right now below the historical trend line, but it's as long as it doesn't get down to this -1 standard deviation, it'll still be considered fairly valued. Margin debt is considered to be undervalued. That was updated at the end of August. And our reversion to the mean with the S&P 500, it's as prices are going down and even as earnings forecasts are going down, we're seeing this really start to come back down to the historical trend line here. So everything is fairly valued except for margin, which is undervalued. Fear is really starting to get extreme negative. We really dropped down this past week. Here's the historical chart just to show how we've been going down. The active asset managers, they're also getting extreme negative down here. And we can often use this as a contrary indicator when it gets to be this low. Sentiment not improving all that much. There's still a real wide disconnect between the 2-year yield and the current sentiment reading. The final reading came out on Friday. The probability of a recession curve, it continues to be pretty high up here, depending on how you measure this. So it's just showing the probability of a US recession in 12 months calculated from the yield curve. It decreased a bit in September, but it's still pretty high right now. The latest reading of the Ridex bear bull ratio shows that people are getting pretty fearful. They're starting to jump more into the bearish funds and getting out of the bullish funds. The individual investor survey that we look at still continues to be extreme negative. We might be able to use that as a contrary indicator. One thing that was a little bit positive is they came out with a revised version of the GDP now, which is forecasting GDP. It had gotten down to 0.3%. Well, with this latest reading, we're back up to 2.4. Now, this is pretty volatile and it can go all over the place, but to have it go back up is somewhat positive. The spread between the risky loans and the not so risky loans, meaning bonds, it did spike up a little bit with some of the instability that we're seeing, but it's not really shooting higher, at least yet. The financial conditions, we also are still below this black line. So there's some indications that things are still under control. Here's a new chart that shows that we are starting to get excessive. These are domestic banks, and it's their tightening standards for commercial and industrial loans from large to middle market firms. When this goes up, that just means that they're getting more strict with their loans, and we're not in the era of free money as much anymore. So this is really starting to go up. That means that it's going to be harder for a lot of companies to get loans, which could stifle growth. Then looking at some Isabel net charts, here's the NYSE composite where we had the 2018 high, then we had the pre-COVID high, and they were kind of in line with each other according to this chart. Now we're coming down. Are we going to be breaking below this as far as the NYSE is concerned? I don't see this as a really accurate chart because they're drawing a straight line across, but there's really a big difference between the pre-COVID high and the 2018 high, and we've already dropped below that. So I'm not sure why they're drawing lines like that. We're seeing a lot of outflows in gold, where a lot of people think that gold should be going up right now. It's not. They're getting very frustrated, so they're starting to take their money out of gold. Insider transactions is bullish right now, but a lot of these folks in companies, it's like, yeah, I'd like to buy some of my own company stock, but why buy it at 30 when if I wait a little while, I could buy it at 25 or 20, get it at a cheaper price. So you don't see a lot of buying right now, and that's come back down more into the bullish camp since there's not a lot going on currently. This is just another look at the same individual investor survey. It just shows how fear is really spiking up. They invert this. This just shows that their bearish readings are getting quite high right now, which often can be used as a contrary indicator. Then the annual rate of UK stock flows, money is just screaming out of stocks in the UK. And they're down $18 billion year to date, and it could even become more than that. We don't know if things have really stabilized or not. Then looking at the 2-year and 10-year Treasury yield forecast, this one thing that's interesting here is the yellow, that's the 10-year, and the green is the 2-year. You notice how these are inverted. So this is what Bank of America right now, they're expecting an inverted yield curve for quite some time, and that means weaker economic conditions. This is what they're forecasting as far as the markets are concerned with right now. And then here's the fact set. It says largest cuts to earnings per share estimates for the third quarter of 2022 in more than 2 years. Here's a chart just showing how they've really been lowering their earnings per share. This is going from 2022 into 2023. The bottom one is showing what we're looking like right now and how they're lowering estimates. And then we're looking out into 2023, how they're also starting to lower their estimates, looking out even into the future. They tend to be more optimistic in the future because they think brighter days are ahead. I think I've read this correctly. It's pretty small and kind of hard to see, but the main thrust of this is that they're just lowering the earnings per share. They have been quite optimistic at the beginning of the summer. We're seeing this coming down, and this is really providing some headwinds to the stock market. The VIX did go up a little bit, and we might be spiking as far as the fear gauge. And here's the bar chart where we ended up going up quite a bit on the weekly chart. The ulcer index, which also measures fear, it's really going up on the daily chart. It's also starting to advance on the weekly chart. I'm not going to update the possible positive scenarios. Please tune into the daily videos to check those out. Looking at earnings, we're still overvalued when you go on a historical basis. We're at 26.84 after Friday's close. We should be between 16 and 17. So looking back, the market is still expensive. Fed watch, right after everything went crazy, that we saw a real spike up over 70%. They were thinking, yeah, they're going to be at 3.75% to 4% after the next meeting. Well, it's starting to come down a little bit now. We don't really pay attention to this an awful lot because we're far away. It's not until November 2nd. It's a month until this meeting will happen. We are continuing to see a depletion in the Fed balance sheet. Okay, looking at breadth, where we just continue to fall based on price and volume, and our advanced decline ratio continues to be negative. New highs, new lows really are dropping off, both with the 4-week and the 10-week moving averages. Accumulation distribution looking negative. At our trend, you see where we're just starting to come back up and turn back above the moving average. So instead of saying a weakening trend, we could actually say that this downtrend is starting to get stronger. The Arun is also just hitting a real extreme negative reading with selling on top. That means they're in control, and buying really dropping off. That's the green line. Comparing the two, we have a real negative oscillator right now. The mass index not generating a signal. We're watching it on the daily chart because it's getting close to possibly generating the first part of a signal, but it's not happening on the weekly chart. Looking at a daily chart here, see where we broke down below this support level to set new lows for 2022. And we're right down here at the bottom as I record this. Are we going to be able to get back above this support level and possibly even go higher? Or is this the beginning of a real solid decline to the downside? Or are we going to chop sideways for a little while? And you can see where volume has been picking up on the daily basis. The trend channel, we are starting to drop down below the midpoint, and that's negative, but not necessarily the end of the world. There have been times when it dropped down here only to come back up. The pivot points, we're kind of in no man's land as far as this calculation is concerned. We have a ways to go, and it's down around 32.66 if we go all the way down to S2. We're well below the 50-period moving average, so that's negative. The long-term trend is negative and declining. The bullish percent index starting to get pretty extreme negative. It could go lower than it is now. We are extreme negative on the daily chart. So we're seeing a bit of a convergence here, but this could still go lower than what we're getting right now. These were the lows that we were reading at the COVID lows. Chicken oscillator starting to get extreme negative. Chicken money flow showing more weakness. The force index also continues to decline. McClellan oscillator getting extreme negative, actually turned back up slightly. So this could provide some support to the market. Summation index based on price and volume, we're getting not quite extreme based on price, but we are extreme based on volume. All of our oscillators continue to go down. The Swinland trading oscillator getting extreme negative and bouncing. We're seeing this on the daily chart too. Even with the down day on Friday, it's turning up slightly. Sometimes this indicator is a leading indicator for us. Unfortunately, it also gives some false signals, so we don't really know at the time if it's legitimate or not. But to see this tick up a little bit based on price and volume, that potentially could be positive. The PMO continues to decline. We're getting extreme based on price and volume with this. So we're really getting overextended to the downside. And we are that way with the daily charts too. The PMOs that are rising, extreme negative, as are the buy signals, as are the PMOs above zero. Same thing as on the daily chart. So we're seeing more of a convergence here. RSI is falling. We are extreme on the daily chart. We're still declining with the weekly chart. Special K just kind of floating around. Extreme negative with the Stoke RSI and the Williams percent R. We are showing the same thing on the daily charts. Vortex negative with the red line on top and advancing. Ultimate oscillator still declining. Money flow indicator is declining, and we are seeing it pretty extreme on the daily chart, and we don't get a lot of those signals. Bollinger Band declining and not necessarily extreme. KST, after trying to turn up positive, is now starting to roll over. The PPO has rolled over and has gone back to negative. Rate of change going back 1 week, not necessarily extreme. Going back a year, we are starting to get extreme if you compare it to other times. Topic curve not helping us now. That signal came and went. It gave us a nice signal right in here in June. We shot up, then everything stalled at the moving average, and then has been coming down. So this indicator is rolling over. This is another very important chart. We've come all the way down on the weekly chart to the 200-week moving average. So if this is right where we closed on Friday. If we break below this, then we're looking at possibly going down to this 50% retracement with the Fibonacci level. But this is pretty significant right here. Can we get some support up off of that? Looking at our charts, we are negative, and these measure trend. So we're down with the Heiken Ashi, we're down with the Kegi, we're down with the Renko, we're actually declining a bit with the ease of movement. We added another 0 with the point and figure chart, and we're still working off of a triple bottom breakdown. We're getting that same signal on the daily chart as well. So again, we're seeing more confirmation there. 3-line break continues to be negative. Our elder impulse is also negative. SAR continues to be negative. So on a trend basis, we're negative. But with some of our other indicators, it's showing that we're getting pretty extreme. Looking at the S&P and how it's declining, the mid caps are holding up a little bit better, and the small caps are not doing quite as well, even though they had a better week than the S&P. All stocks continue to be in a decline, and the mid caps decline and downtrend. Small caps decline and downtrend. The Dow decline and downtrend. The NASDAQ decline and coming down here and matching the low. It hasn't necessarily broke through to a new intraday low or intra-week low, I should say. So this could offer some support. And if we're going to get some guts to the upside, it's probably going to come from the NASDAQ and the NASDAQ 100, since those are growth stocks. So we want to be watching this level, even though we closed pretty much at the low at the end of the week. NASDAQ 100 also, will this support hold in here? Wilshire starting to break down a little bit more. NYSE also breaking down. FANG stocks also holding just a little bit above support on an intraday basis, but setting a new low on a closing basis. ARC also, could it be holding up? It was only down 0.26 for the week. Usually this thing moves a lot more than that. Could there be a glimmer of hope in ARC, or is this just getting ready to fall even more than it already has? Software companies, the biggest companies that we have, continue to be in a downtrend, but may be holding up some kind of support here. Dow theory breaking to a new low with the Dow. Transports making a new 52-week low. Utilities, which had been holding up best, now look at how they really shot down in this past week. So a lot of weakness was done in the utility sector this past week. CRB index dropping below the 200-day moving average, the 50-period moving average, but still in an uptrend. But this uptrend could be in jeopardy. Some are attributing this to the strength in the dollar because commodities, most of them, are dollar denominated. And so when the dollar goes up, that means that prices usually have to come down. Copper was up about 2% on the week, but still is in an uptrend, but has really fallen as of late. Gold just continues to be in a downtrend. Silver is still in a downtrend. Oil dropped below 80 at 79.49. The dollar, which showed some weakness this past week, has just been skyrocketing up. And here's the British pound. I usually don't show this chart. It really came down. This was Wednesday when it just went down, down, down. It has since been bouncing back up. But is this going to continue to go up, which might cause some dollar weakness? If the dollar goes down, that might give some support to stocks. Or is this just a dead cat bounce before we get set to go even lower? Looking at bonds, we're not getting any help there. Bonds based on price continue to fall. Interest rates, this is a daily chart. Overall, interest rates are just going up. And look, this is the blue line, which is the 2-year yield. That's where you're getting the best yield right now. The 10-year is the red line. And see, it's in third place down here. This is a weekly chart showing how US rates, UK rates, and German rates are really going up. Here's Japan, which they're kind of in their own different disastrous scenario that could play into our future at some point as well. Relative studies, we actually had the dollar overtake oil as far as performing the best going back to the beginning of the year. Since then, oil has gone back in the lead, but is showing some recent weakness. We have gold, stocks, and bonds that are negative on the year. The bond to stock ratio shows that bonds, shorter term bonds, are outperforming stocks, but have a long way to go if they're going to really establish an uptrend. On the monthly chart, we saw a little bit of weakness with the stock to bond ratio. Stocks have been outperforming bonds, but it curled over just a little bit. Gold to the US dollar, well, gold is going down, the dollar is going up. So overall, this chart is in hefty decline. Gold to the S&P, even though gold has been going down, the S&P has been going down more. So gold has been outperforming the S&P. Low volatility. These are the stocks that tend to hold up better when we're going down. This still continues to be in an uptrend, even though we saw some weakness this past week. Growth to value. Growth is still really suffering and in an overall downtrend when compared to value. NASDAQ 100, which is growth, compared to the S&P 500, which is value and growth, still is underperforming. S&P 100 to the S&P 500 is also in a downtrend. Discretionary, which had been trying to stage some kind of a comeback, has now been showing weakness when compared to staples. Energy just continues to go up when you compare it to tech. So what is the outlook then? We have a lot of reports being released. On Monday, we have the IHS market manufacturing PMI. That's not a real big market mover. But the ISM manufacturing index, that is, and that could have a real impact on things. And we will also get construction spending. On Tuesday, we have factory orders and the JOLTS jobs opening. Then on Wednesday, we have ADP employment change. That'll be coming out. And then every week we get the mortgage applications index, the trade balance, and then the market services PMI final. Again, not a real biggie, but we are going to get the non-manufacturing ISM, and that is a big deal. Then on Thursday, we have jobless claims. And then on Friday, we have the employment situation report. So we'll get more insight as to what's going on concerning employment. We also get wholesale inventories and consumer credit. The technicals, they are negative, but showing some extreme negative readings right now. Inflation and interest rates are the real fixation of the market. We've got a lot of geopolitical concerns. Expect those to continue, and who knows what new ones will crop up in the next week. The situation between Russia and Ukraine, it's tenuous at best. And then China and supply chain issues, any Fed speak that will come out, earnings might have an impact on the market, or even earnings announcements. And I've added the UK to our list of things to watch. So our scenario just for Monday, it's really hard to go with the down scenario. Yeah, we're negative and everything's pointing down, but we're very oversold on a short, intermediate, and even somewhat of a long-term basis. We can't really go up because everything is pointing down right now. So until we see follow through with price, we can't really, and this buy the dip thing just tends to wipe people out if you really try that. We can't really go sideways because on the daily chart, the ADX is above 20, and the weekly chart, it's starting to turn back up as well. So it's really hard to do trend-based strategies right now. So thank you. I hope you found this helpful. Please feel free to check out the daily videos. I'll also be posting the intermarket analysis video. So have a great week. Go Seattle Mariners, and I'll talk to you next week.